Hey there, I'm John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, let's answer the question, if annuities go down or lose money, or what happens to them when the market crashes. Okay, so you're probably worried about a market crash if you're watching this video, or maybe you're just wondering what would happen to your current annuity contract, or what would happen if you purchased one and then the market crashed. Okay, how would the insurance company fare? Like, how would things go for your contract? Would there be problems? Okay, would you stand to lose a ton of money based off of that huge crash? So if you're in the stock market, yes, absolutely, you'll lose money if the market crashes, but that's only if you liquidate, right? That's only if you realize your losses by actually getting out. With an annuity contract, now I'm talking about fixed contracts or fixed indexed annuities, because if you're in a variable annuity, then those are tied to market indexes through sub-accounts, and they absolutely will go down when the market goes down, depending on what you're invested in. But what I focus on is guarantees, and I focus on market protection, and I focus on peace of mind. That's why people reach out to me. So if you're looking for an annuity like that, maybe you're looking for highest lifetime income, then I would recommend going to my annuity calculators on my website, and you'll see Income Rider for the highest income options. You got SPIAs and DIAs, QLACs, you have MIGAs for fixed rate options, and these are all designed to protect your money. They're all designed to give you guaranteed growth for either income or just for legacy, just depending on what you're looking for. So I'd be happy to help you if you're looking for that. And of course, there is a link below this video that goes directly to my calendar, and you can book a call with me there as well. So let's chat about market crashes. Okay, what happened in 2008? Well, 2008, of course, as we know, the housing boom was brought to an abrupt halt because the market, of course, crashed because of all those horrible loans, and it was bad, right? And it went down a lot. All of our accounts went down. Okay, and if you bought a house, then your house. I remember my house. It went down like a lot. 65%, because I had my house in Las Vegas. And then I bought another house when it was at the low point. So I was kind of able to average it out, which was nice. But it's still not fun. Okay. It's not fun when you got a market crash and you see all your earnings and all your growth just evaporate. Okay. With annuity contracts, if you were either in a fixed index annuity or a fixed annuity like a MIGA, you didn't lose a dime, because you weren't actually in the stock market. Okay. And I'll show my screen here in just a second, and I'll show you what those look like. But with fixed rate annuities, those are tied to interest rates. Okay. Interest rates are tied to bonds, are tied to debt. Okay. And those didn't lose a dime because they were tied to debt that was being paid and interest that was being paid. And the stock market, it's not debt. That is ownership of companies. And when that plummets, the value of that security goes down, and so does your account value. Okay. With annuities, it's quite different. And of course, with MIGAs, they were protected, but you also have fixed index annuities. And a lot of times when people hear index, they're like, oh, wait a second, index, that means I lose money. No, it doesn't, because these are fixed index, which means they are tied to an index like the S&P 500. But what's happening is you're not actually owning this security, and neither is the insurance company. What's happening is you have your money in this contract. The insurance company is buying call options associated with this index, okay? And they're hoping that the market goes up. But if the market doesn't and it drops, what happens to those call options? Well, they expire worthless, because they are worthless. You're not going to exercise those and lose money. You're just going to lose your premium. Okay. So what happens is the insurance company pays a premium, not you. They are paying a premium for these call options, and they're hoping to exercise that call option. But if the call option, is not worth anything, if the market drops, they're not going to be able to exercise it, and they lose the cost of that option. But that's it. So that's why during the years where it's good, okay, they're exercising those call options. They're making money, and so are you. They're giving you some of it, but they're not giving all of it to you, because they got to make up for all the premiums that they spent earlier for the options that they did not get to exercise. Okay. So that's the cost of protection, the cost of peace of mind. So that's how you stay out of the market. Okay. Let me share my screen and I'll show you what this looks like. All right. So looking at income, you'll notice this couple, they're based out of Florida. They're both 60 years old, $500,000, and they're going to take income in 7 years. So they're just putting $500,000 in. They want market protection. They want guaranteed growth, and they want income. in 7 years as a joint payout. Okay, something that never runs out for both of their lives. And I'll show you the other options right after this that are just based off growth and market protection as well. This one is growth and market protection, but mostly it is based off of income. Okay, so if we look at the income need or the income benefit, it is $60,000 a year coming from ClearSpring, followed by Corebridge, Nationwide, and American Equity. Pretty good. You can go down, you can see all the rest of the other carriers. But if you just look at the top one with ClearSpring, just kind of give you an idea what this would do. You can see the payout. They're showing you if the market is down, okay? So if the index is down, they're not going to exercise any call options, which means you're not going to get any growth. But then you're looking at this and you're saying, well, wait a second. Hold on, John. You just told me I wasn't going to lose any money. Well, guess what? In this particular example, I'm showing you an income rider attached. This is a lifetime income. This is a guaranteed pension. Okay, I'm going to show you the no fee options after this, but I just wanted you to see if you're looking for income, it's worth it. Yeah, your rider charges are right here. You can see them right here. They go down after a while because there's nothing left in the account, and they're only taken from the account value, not from the income. So these rider charges give you guaranteed growth right here. See the benefit base? This is guaranteed. This is what you're paying for. And if you wait 7 years, it's $925 multiplied by 6.55, giving you the $60,000 a year. That's how that works. So they show you that and say, well, here's what it looks like if we can't exercise those call options. But then they show you, here's what it looks like if we can. We're going to give you some of the growth, and your account balance is going to last longer. Okay. And it'll get a little bit of growth, right? That's what it should do. That's what it's done in the past, and you'll be fine. But again, you're buying this for this, the income benefit base, okay? The rider charge is what's giving you this. This is guaranteed regardless, okay? And you want that because even if your account value grows to 600,000, you don't want your income based off of 600,000. You want it based off of the 925. So anyways, over time though, your account value still loses value, and by the time you're 80, it's gone. And then you can see the income keeps on going. And if you live to 95, it's a $1.7 million payout. Okay. If you live longer, it pays out more. And this is joint, so it pays out to you and your spouse. And it is designed for that. Okay. It's designed for the account balance to run out, and it's designed to give you highest lifetime income. That is what this is for. So it gives you the market protection. It gives you the growth based off of the index. Okay. And they're only giving you a portion of the S&P, not all of it. And then they're charging you a rider charge for this guaranteed income benefit base growth for your income. That is what that's for. Okay. Now let me go to a fixed index annuity without any of those rider charges, just so you can see bare bones growth and market protection. Okay. So I'm going to go, let me go back here. All right. So with just bare bones fixed index annuities, okay, I didn't put any filters on here. You can see on this page alone, there is almost 4,000 options. Okay. There's a lot to look at. That's why I'm an expert, and I look at all these companies and I know which ones to recommend because I look at their renewal rate history. Renewal rate history is their participation rates, their cap rates, and which companies keep their caps and par rates with those indexes consistent or close to consistent year after year. Because a lot of these guys will sell you something and they'll make a huge commission, and then the rates will drop through the floor, and then you're not making hardly any money after that, and you're locked in. Yeah, you don't want that. So anyways, going in here, you can see all these huge growth rates, and you see this only based off of 10 years. It's because they're all back tested. Okay. They're not real indexes. They're indexes. They are indexes, but they're brand new, and they back tested them and I think they should work, but a lot of times they don't work. And so I recommend, if you are looking at these growth strategies, stick with the S&P 500 or NASDAQ. Okay. PIMCO is not bad either with Allianz, especially with the interest rate environment. But I still like S&P as far as my favorite as far as growth. So I'm going to go in here and I'm just going to pull up Delaware. I talk about Delaware a lot just because they've got a great renewal rate history among many other companies that I recommend. But Delaware is just one I just want to do an example of today. So we'll say the S&P 500. Pull that up here. And then we're going to do the 55% participation rate. You can do the cap, but the cap doesn't do as well as the participation rate. So we'll go in here and we'll say, with 500,000, what does this grow to? And they show you worst case, if the index does nothing, they can't exercise those call options, your account value stays exactly the same. Because remember, this is not an income product. You can take withdrawals and treat it like income, but it's not guaranteed like an income rider. Okay. So $500,000, that's guaranteed to be there, because if there's no growth and it's just losses, well, they're not in the market and neither of you. Okay. But it's kind of nice. I do give you a death benefit that rises over time. That's kind of nice. But really what you want to see is this. This is the projected growth, the most likely scenario. And you notice I'm not showing you 20% or 30% returns. And a lot of guys will show you those based off of indexes that I promise you they'll never return that. So I'm trying to be as conservative as possible when I'm showing this to you because I want you to be happy in 10 years and still want to talk to me. But if you're looking at a 10-year return, it's going to grow probably to 1 million, maybe 1.1. Okay, and you can see right there. Now, if there's some years where there's a recession, it won't grow as much, but you'll be protected. Okay, and that's why you can see this is showing the last 10 years of the S&P based off of a 55% participation rate. That's how much they're giving you. So based off of that, it should grow to almost $1.1 million. If you let that thing sit and grow, well, by the time you're in your 90s, it's almost $6 million. Actually, 6.7 right here at the end of the year. So anyways, and an annual effective rate of return, not bad, 8%. Not as much as the stock market, but you're still getting decent growth. So when I'm looking at growth products, typically I like these. So, and I've got people in these and they're doing well. So that's just something to think about. You don't have to do this. You can do income, and I love income. And most people, when they're looking for lifetime income, that's what they want. Okay, they want the income. They don't care about the account balance. They realize the account balance is going to run out, and they're going to leave their other assets like their cash and stock and house to their kids or whoever their beneficiaries are. Like that is what they do with their legacy accounts. But with income accounts, you usually want the indexed annuity with the income rider. Sometimes a SPIA or a DIA makes sense, but most of the time the income rider will give you the most. So that's for income. Otherwise, if you just want growth, okay, if you want growth and you want to protect it against a market crash, and that is it, then I recommend something like this. Okay, the fixed index annuity without the income rider. Very boring, but it works. Okay, and you got to do it with the right company. Okay, and Delaware's one, Lincoln's another. National Life Group, Gillico's another. Okay, I like to work with companies that are known to keep their participation rates and their cap rates high year after year. Okay, it doesn't mean they don't lower them. They do sometimes, but sometimes they raise them too. But I like these particular companies because they have good renewal rates, and I want you to have a good renewal rate. I don't want to throw you in Allianz with some product or maybe North American, and these are good companies too. They've got really good things too, depending on what you're looking for. But I have people that have gone over there and that they've put these annuities in place for growth, and they've had their cap and participation rates go down a lot. And so that poses a problem when you're only earning 3% a year, and you're like, man, I wish this guy would have told me that this bonus that I was sold would make the rest of my account underperform for the next 10 years. Okay. A lot of things they don't talk to you about that I'm talking to you about. Okay. So anyways, if that makes sense, if you're looking to purchase an annuity, I'd love to help you. Go to my website, johnstevenson.com, check out the annuities that are available. And if you want to book a call there, you can. Otherwise, there's a link right below this video to book a call as well. And if you like the video, make sure you click the like button, subscribe, share, comment below if you got questions. I'd love to help you buy an annuity if that's what you're looking for. If not, continue to do your research, watch my videos, and browse on my website and look at those calculators, and hopefully that will help you in your research. So again, I appreciate you. Thank you so much for watching, and we'll see you next time.